And if that price analog has some validity for what we're going to see going forward, it would take the S&P 500 down to almost 2,000 on the downside. And so that takes you down, 50% from today's levels.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with macro analyst Jesse Felder. If you haven't yet watched part 1 of this discussion with Jesse, in which he hammers home why he thinks 2022 will go down in the history books, marking a paradigm shift from a multi-decade era of disinflation to one of systemic inflation, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Jesse also shares his outlook on which assets will perform best through the rough ride he sees ahead for the rest of the year, so be sure to stick around to the end for that. Okay, let's get started watching part 2 of our interview with Jesse Felder. Everybody running our system right now, pretty much, for their lifetimes, has lived in a disinflationary environment, right? So that's all they know, pretty much, right? So again, I'm going to use the musculature analogy, but the muscles they've developed is, okay, how to deal with disinflation. To your point, we're now moving into a inflationary regime, needs a totally different set of rules. And so, you can make a good argument that the people we have running the system right now are uniquely the wrong people to be running it, right? Because it's like a wide receiver versus a defensive lineman, right? They just have different musculatures. And it's like we're all of a sudden asking the defensive lineman to, be the wide receiver and be the guy who wins the sprint. It's just not going to happen, right?
Right. Well, and if you think about, what do you really need to rein in inflation? What you really need is positive real interest rates. You probably, let's just say, core CPI is going to come down to, or core PCE is going to come down, let's say 4%. Let's be generous by the end of the year. That means you need a 5% Fed funds rate. Bill Dudley has said this. You need a Fed funds rate that's positive in real terms to really address the inflation problem. We're not going to get a 5% Fed funds rate by the end of the year. But at the same token, MMT, modern monetary theory has said you can go ahead and print money. When you get inflation, the way you deal with that is not through monetary policy. You need to raise taxes, right? And so you need fiscal policy to also work to rein in inflation. But imagine, trying to get politicians to raise taxes right now in the midst of this inflationary regime. There's not anybody in Congress right now who's even willing to go anywhere near this issue, because people are already suffering from rising prices so significantly, right? And so the idea of raising taxes is just anathema to politicians. And so, what you probably need is monetary and fiscal policy to work together to address the problem right now, and it's just not going to happen. So, to your point, yes, the people that we have, and Jay Powell's a great example too. You come back to monetary policy. He said a couple of years ago, low inflation is the greatest challenge of our time. Right. I mean, they have this idea that, deflation is the real monster. And you have, the economists tell you that inflation is dead, and Bloomberg Business Week tell you the same thing. And, and so there was this mindset, driven by 40 years of disinflation, that deflation is really the real boogeyman. And that's, so shifting those mindsets to really understand what the problem is today is going to take a lot of time. And it's, that's why I think we're in another, 1970s type of situation right now. We could see inflation cyclically peak here, in July. Gas prices come down, commodity prices come down. But a cyclical peak doesn't mean that it's that this inflation problem isn't done on a longer term time frame. And so I think that's what people are really betting on right now. So we'll see a cyclical peak, and inflation will come back to the Fed's target, and it'll be done. That's where the market mispricing is off. I think that, yes, we could see a cyclical peak, but the problem's not going away. And just like we saw in the 70s, we could have, a larger trend of higher peaks, higher highs and higher lows in inflation over a period of years. that's something markets aren't even considering right now.
Right. And it seems like from what you're saying, you think that is more probable at this point in time.
Absolutely. I mean, you have, it's insane that, the Taylor rule says Fed funds should be 10% today, right? And so the Fed is laughably behind the curve. The idea that, Jay Powell would say they've now reached the neutral level with, this 2.25% to 2.5% range in Fed funds when CPI is 9. It would be laughable if it wasn't so painful to consumers right now. I think it's, I've said, Stan Druckenmiller used to go to his investment team and say, you just came down from Mars. Here's what the economic data is. Here's all this stuff. Where do you think Fed funds is? Nominal GDP is running 7-8%, right? Inflation's 9, so you're getting negative real GDP of 1. Retail sales, nominal retail sales are up, 7-8%, all these things. You just came down from Mars. Where do you think Fed funds rate is? And I mean, anybody in their right mind would say Fed funds has got to be 7, 8, 9%, right? At least the inflation rate. Now I tell you, you just came from Mars. Fed funds rate is 2.5%. What do you do with your investments? I think that's how people should need to be thinking about this, and because the answer is simple. Say, I don't want to own financial assets of any kind. I'm not going to buy it. Interest rates might come down in the short run, but I don't want to buy a 10-year, treasury yielding 2.5. I don't want to own stocks at the highest valuations. Literally today, even after the correction, the most valuable valuation metrics are still above every previous peak we've ever seen in stock market history. I don't want to own equities at that, kind of overvalued. I need to own things that are real assets that are going to protect me from this, probably the biggest mistake in Fed history.
All right, let me interrupt you here because there's a point I've been trying to get through to get to the details of your market outlook here. It's a chart that you shared on Twitter recently showing that intangible assets make up 90+% of the value of the assets in the S&P 500. So, that's things like patents and goodwill and all sorts of things like that. It's a mind-bogglingly high percentage, and it makes me ask the question: how much of the current market value of the S&P is perhaps like phantom value, like value that really can't be, justified by fundamentals, and we're all just kind of crossing our fingers and just wishing that yes, these intangibles are worth what they're saying they're worth?
Well, yes. I mean, price to book value is one way to value the equity market, and a lot of growth investors have said this is this is an outdated way to look at markets. Ben Graham, were he still alive, would beg to differ that tangible assets are really the only thing you have to hang on to in times of distress. But people don't even think about times of distress, right? Financial crisis is a distant memory. So in most people's minds, if they even were old enough to know what it was when we went through it. But I think the biggest issue for me is that people are looking to forward price to earnings ratios, even trailing price to earnings ratios, without understanding that profit margins are at their highest levels in history. And profit margins are one of these things that are very cyclical, and Jeremy Grantham's called them the most mean reverting series in finance. So if you're using a price to earnings ratio, and those earnings are inflated, by the highest value margins in history, you're making an assumption that profit margins are going to stay elevated indefinitely into the future. That's an embedded assumption when you're using a price to earnings metric. And so I think that's something that just people don't even consider, don't even appreciate. Well, what if profit margins mean revert back to just a normal historical level? Well, that means we're not at 16 times earnings. It means we're 30, 40 times earnings right now, right? When you normalize for profit margins. And so that's why I say, when you look at, any type of long-term valuable measure of valuations, we're at the highest, we're still above all the previous peaks in stock market history. So you can talk about what would make for a mean reversion in corporate profits. I think the biggest thing for investors to consider is that wealth inequality has been gotten to a point where we're starting to see political problems. Warren Buffett wrote about this in his famous 1999 and 2001 articles in Fortune magazine, where he talked about the dot-com bubble. And he said, when corporate profits, you really can't expect corporate profits to be above 6% of GDP for any prolonged period of time, because you'll get political problems. If corporations are taking a bigger slice of the pie than labor for too long of a period of time, you get political problems. And so I think that's what we're seeing today with, corporate profits have been so elevated for so long. And that's one of the things that's been driving wealth inequality, where labor has been taking a much smaller share for so long, that we're starting to see a reversal in this dynamic. And this comes back to globalization and all these things, right? What enabled corporate profits to do what they did was offshoring of labor, right? That enabled corporate profits to be so elevated because they lowered their cost of doing business. So deglobalization is also the probably will make for a peak, a long-term peak in corporate profit margins, that we'll look back and say, wow, 2022, 2021, those profit margins were literally off the chart. And we're starting to see, political movements towards that are starting to address things like wealth inequality. And what that means is addressing corporate profits. I think we're probably going to see a raise in the corporate income tax, and we're seeing a 15%. Democrats are really pushing for a 15% minimum tax. That's probably just a start, because what you understand when you look at history is wealth inequality does this for long periods of time, where it widens and the wealthy take a greater pie. And then you either get a redistribution through, the democratic process, or you get revolution.
Or the pitchforks come out. Yeah.
Yeah, exactly. And so we're at that point where you're going to get redistribution or you're going to get revolution. And that's, you can read The Fourth Turning, by Neil Howe. And, a lot of people have talked about it in different ways, but I think that's where we're at. And it puts a big red target on financial assets in general.
Okay, so let's then go into your market outlook, but through that door, which is corporate profits are at the highest percent that they've been, or we've had a little bit of a bruising year. Maybe they're not at the exact record, but they're super duper close. You just mentioned a bunch of additional factors that are going to compress profits from the bottom up, right? Which are these increased costs of globalization and labor, wages, and things like that. Input costs on inflation. But then you also have demand destruction, whether it's organic because inflation has gotten so high that people are buying less, or we just go into a recession and companies have to start laying people off and people have less money to buy, and there's a negative wealth effect and housing rolls over and everybody just retrenches, right? So I'm getting to the question of how far do you think this thing could fall, right? And I just want to go back to mention that chart about the 90% of profits being intangibles. That's a highly financialized valuation on those types of assets. So you might imagine that in a world where people are scrambling for safety, folks aren't going to be willing to pay up a lot for a company that's got all intangible assets, right? So let me get back to that question, which is, as you think the bear market could continue, how vulnerable are we here at this state?
I think we're very vulnerable. Corporate profits, I mentioned relative to GDP, Buffett said any time spent above 6% of GDP, you can't assume that indefinitely into the future. We hit, last year we hit 11% of GDP. It's fallen back down to about 10% of GDP. But if we fall back down to, 6%, which Buffett said was on the high side, right? That means corporate profit margins are essentially cut in half, like I said. So that means the PE ratio, instead of being 16, 17 or whatever it is 32, 35, something like that. And, so what multiple do you put on that? Well, you probably, put a 15 multiple on normalized earnings. And so that takes you down, 50% from today's levels. One of the things I've been paying close attention to, I'm a fan of price analogs because I do think history rhymes, even if it doesn't repeat. This is one of the things Paul Tudor Jones used the 1929 stock market crash, the price analog, just the simple price pattern. He overlaid that on the 1987 stock market. And if you go watch the documentary, I think it was PBS documentary Trader, which was about Paul Tudor Jones, it's him in real time trading the 1987 crash, at least the months leading up to the 87 crash. But one of his key tools that he used was this 1929 price analog, which had a very high correlation to the prices leading up to 87 crash. And it helped him, profit from that opportunity. I think he's removed all the copies of that video from YouTube and whatever every time they pop up. And I think it's because he doesn't want to be seen as profiting from people's misfortune, which is absolutely understandable. But when you get past that, understand, his methodology, you can look at what are some of the price analogs that are very similar to what we've seen today. And the 1973-74 bear market has a very high correlation to the bear market we've seen so far this year. And that's fascinating to me because 73-74 was also the time when inflation was really taking off. The Fed was behind the curve. We went into recession. Fed, cut interest rates from 10 to 5%. And that cut in Fed funds allowed inflation to take off again in the late 70s. They didn't do enough. But that stock market decline from 73-74, went from about 120 on the S&P to about 60. And there was a nice rally in there in late 73, which is kind of what we're seeing right now. And if that price analog has some validity for what we're going to see going forward, it would take the S&P 500 down to almost 2,000 on the downside. That to me is just kind of helpful in understanding what is the potential for risk if we really do go into recession, we do see an earnings decline. Is similar to what you see in a normal recessionary environment. That would also be the type of earnings decline insiders have been pointing to, the type of decline, like I mentioned at the outset, the dollar, interest rates, oil prices have been pointing to. That type of an earnings recession, I think, could catalyze that type of a decline in stocks. So I think that's the risk that investors really need to appreciate right now.
All right. Wow, really well said. We're going to dig into the 1973, 1974 data after this interview, given that it sounds like it's such a close analog. All right, Jesse, well, look, we're getting a little close on time. So I'm going to jump right to the punchline here, which is, it sounds like you're fairly pessimistic about most sort of traditional financial assets. So what assets do you like right now? And I'm sure you're going to put energy in the mix, given what you said earlier on in this interview.
Yeah, I really still like energy stocks. I think they're significantly undervalued. I mean, a lot of these things are trading 5 times cash flow and things still. And that's basically just a signal that investors think that they are at a cyclical peak, that oil prices are going to be peaking out. From a purely technical standpoint, the oil price to me has traced out a typical bullish flag pattern over the last, several months, 4 or 5 months. If that, is a valid reading of that, then the oil price could break out to the upside sometime over the next few months and really surprise people on the upside. I'm talking, $150, $200 a barrel. If that, happens, then obviously the valuations for oil companies, oil producers and things is silly at today's prices. But I generally think investors need to focus on real assets right now. I think gold prices are dramatically undervalued given where real interest rates are today. I think precious metals generally.
Sorry to interrupt, but just in your answer, can you address why gold hasn't done as well as people thought? Given, kind of do a Druckenmiller exercise. If we went back 2 years and said, okay, look, this is what's going to happen. Central banks are going to print, $20+ trillion, worth of monetary stimulus. Fiscal stimulus is going to support that, and then inflation's going to rocket off to above 9%. I think we all would have predicted a much higher gold price than we are right now. So in your answer, if you can just explain why.
Absolutely. So when you have negative real interest rates, that is the bullish backdrop, the most bullish backdrop you have for precious metals prices. The reason it hasn't been for the past couple of years, we've been in a pretty significant sideways pattern for precious metals, is I think two things. It's the dollar. The dollar has been pricing hawkish Fed policy for, and especially this year, right? But really, precious metals prices have held up relatively well relative when you look at the strength in the dollar. But that's one thing. I think investors are pricing in a hawkish Fed, and when you look at the other side of it, break evens. Essentially, for better or worse, the gold price is tied to the TIPS price. Break evens. Right now, break evens are pricing in a rapid, reduction in inflation. And so I think basically by saying gold's undervalued, I'm saying I think TIPS are undervalued. That break evens are not. Break evens are going to be dead wrong where inflation is in 2 years, 5 years, 10 years from now. I think inflation is going to be much higher than break evens are pricing in. If that's correct, then the gold price is really going to take off, and there's really no reason to believe that gold prices should be tied to TIPS going forward, right? I think before this bull market in commodities is over, you're going to have a lot of these relationships are going to go to the wayside, and we're going to see the type of sentiment that we saw in meme stocks. In January of 2021, this to the moon, all these types of, stocks only go up. We're going to see that kind of sentiment in commodities. We're going to see that kind of bullishness in oil towards oil price. We're going to see that bullishness towards precious metals before this commodities bull market is over. And so that's why I think we're still in the very early stages of the commodity bull market. And positioning there too is very bearish. We saw managed money traders in futures, gold futures, go net short recently. That's usually only seen at important lows for precious metals. You still have producers in gold and in silver very bullishly positioned. So I think there's a very strong bull case to be made for precious metals going forward.
All right, great. So, and I did interrupt you a little bit there. So if there's anything more to add in terms of other assets you like, please add them. But we got energy stocks, we got precious metals, maybe even TIPS a little bit, commodities in general. When you talk about these plays, you say you don't like financial assets, but most people, common way for them to get exposure to these sectors is by buying stocks, either ETFs on the commodities themselves or buying producers or other players in the sector. Is that the way that you would sort of generally tell the average person to look into this, or are there other vehicles you would encourage them to look at?
No, I do like, I like owning, I don't want to own, the oil price. I don't want to try and roll oil futures or anything like that. So I would rather own the producers there. I think the energy infrastructure companies are still really attractive. Pipeline companies, those types of things, they're still paying, 8 to 10% yields in dividends. And they're priced as if we're going to stop using, fossil fuels in the next 5 years, which is ridiculous. We're going to be needing this type of energy for a long period of time. And so the valuations of these things is still pretty cheap. I do like precious metals mining stocks. I think they're dramatically undervalued right now, but I also do want to own some gold and silver, physical as well. I think that's something that's a lot easier to own than other commodities. So I do like those. And I'll say too that there are, I generally don't like the equity market because I think that, it's dramatically overvalued still. But within the equity market, we are starting to see a lot of interesting opportunities where you are seeing insider buying and valuations come down to attractive levels. Especially back in mid-June, there were stocks that had very heavy insider buying and got to levels that were just unjustifiably cheap. And so I do think there still is opportunity in the equity market, but as you said, you need to be very tactical. You need to be very bottom up and really pick your spots.
All right, thanks. And you're making sort of an indirect plug for the active managers that Wealthion refers people to, who can help them put together, a portfolio and a strategy to target those types of companies. All right. Well, look, I hate to cut it here. We both have hard stops coming up. Real quick, for folks that have really enjoyed getting to know you in this interview, Jesse, and would like to follow you and your work, where should they go?
I'm pretty active on Twitter. It's just at Jesse Felder. I try and share tons of stuff that I'm reading, charts that I think that are interesting, that sort of thing. Once a week, I'll put up a blog post at the Felder Report, or a podcast, on occasion when I see fit to do an interview. I also put out a free Saturday email newsletter. You can sign up there for on my own website. It's pretty much just I curate, the 5 most interesting things I found during the week, whether it's a chart or article, that sort of thing. And like I said, yeah, that's just thefelderreport.com.
All right, great. When we edit this, Jesse, we'll put the URLs to your Twitter handle and your website up there so folks can go there. And I am a very frequent consumer of your content. You're just a great aggregator of really critical and germane data. All right, folks. Well, look, thanks so much for watching yet another interview here on this channel. If you would like to get my notes in terms of my key takeaways from this discussion with Jesse, we are continuing the Adams Notes program. Had really good feedback so far. So if you want to go get the notes to this discussion for free, just go to wealthion.com/Adams Notes. And if you enjoyed seeing Jesse on here, want to see him back on the program again and see us get other great minds like him, do us a favor and support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Jesse, it's just been wonderful having you on. Look forward to having you back on later on in the fall for an Audible update. And just thanks so much for doing all you do.
Sounds great. Thanks, Adam.